Can you invest in the stock market without losing a single penny? I mean, it's easily one of the most alluring marketing promises in finance today, right? A 100% downside buffer against market crashes. It sounds like an absolute dream for the anxious investor. But as we're going to see, the reality behind this promise involves a very strict, completely uncompromising timeline.
Welcome to this explainer. Today, we are going to impartially unpack the dense prospectus of defined protection ETFs, and we're going to focus really heavily on the absolute necessity of the strict 2-year holding period required for these funds. We're going to look past the flashy marketing headlines to understand the mathematical and, frankly, the behavioral realities of how these instruments actually work.
Okay, let's dive right into this. We've got 6 parts to cover. 1. The promise of complete protection. 2. Under the hood with flex options. 3. The catch of upside caps. 4. Risks of the 2-year timeline. 5. Dangers of intra-period trading. And 6. The multi-period rollover trap.
All right, kicking things off with Section 1, the promise of complete protection.
So what exactly is the initial appeal drawing everyone to these funds? Well, the prospectus defines the buffer directly, stating that the fund seeks to protect against 100% of the underlying ETF losses over the course of the outcome period. But, and this is an absolutely crucial distinction, that protection is calculated prior to fees. Once you apply the fund's 0.79% management fee, your actual net buffer drops to 98.42%. So while it is totally substantial downside protection, in practical terms, it's not mathematically a full 100%.
To put this into perspective and see how it's engineered to work, imagine a truly worst-case scenario. If the underlying market index were to theoretically drop by a catastrophic 100%, the fund is engineered to essentially act like a giant financial shock absorber. It takes all of that blow, resulting in a 0% loss for the fund prior to those management fees.
Moving along to Section 2, under the hood with flex options.
So, you're probably wondering, how on earth is this massive protection achieved mathematically? Well, the fund doesn't just buy a regular basket of stocks. In fact, you aren't actually owning the companies in the index at all. Instead, you're owning complex contracts. The fund invests substantially all of its assets in something called flex options. These are highly customizable exchange-traded option contracts. By buying and selling specific call and put options at very precise strike prices, the fund's managers create these complex layers that engineer the defined payoff profile.
Now, pay close attention to the technical designation of these options. They are European style. This is a massive detail for investors to wrap their heads around. It means these options can only be exercised on their final expiration date. They do not adjust dynamically every single day for you to just cash out your protected value whenever you feel like it. The protective magic that creates the buffer, it literally only happens officially on one specific day in the exact future.
Which brings us to Section 3, the catch, otherwise known as upside caps. You know the old saying, there's no free lunch in finance? Well, because getting that level of downside protection requires a major trade-off on your potential gains. There is an absolute hard limit on your upside, the cap. No matter how high the underlying market flies, your returns will hit that ceiling and just completely flatline.
Let's walk through some hard numbers because it makes this very, very clear. Say the cap is set at 13.61% before fees. If the market goes on an absolute tear and skyrockets by 50% or even 100% over the period, an investor in this fund still only gets that 13.61%. You are intentionally giving up massive wealth-building gains in exchange for that downside buffer.
And now, Section 4, Risks of the 2-year timeline. This is the big one, folks.
This really brings us to the absolute climax of this explainer. Unlike other defined outcome ETFs, this specific fund utilizes an extended 2-year outcome period, and the prospectus explicitly warns that this extended length can really exacerbate your risks. Think of this 2-year timeline exactly like a roller coaster ride. The safety harness, the buffer, only works if you stay strapped in your seat until the ride comes to a complete full stop at exactly month 24. During month 12, those options haven't expired yet, their values fluctuating based on time decay and market volatility, meaning the fund's value is absolutely not perfectly tracking the underlying market on a day-to-day basis.
Which leads us straight into Section 5, Dangers of Intra-Period Trading.
Knowing that the options only officially settle at the end of 2 full years, we have to talk about the severe behavioral realities if an investor decides to get on or off this roller coaster mid-ride. The prospectus draws a really stark contrast here. Holding for the full 24 months offers the intended safety of the defined cap and buffer.
But buying or selling intra-period, literally at any point between day 1 and the end of year 2, is a super dangerous reality. During that interim time, the buffer might not be fully operative at all, and your investment returns are going to look very different from the fund's stated goals.
Let's look at how this actually plays out in a few specific, hypothetical scenarios. If you buy into the fund after the market has already risen, you have absolutely zero downside protection on those new gains until the fund's price falls all the way back to its original day 1 value. If you buy in after a market drop, well, you don't get the full buffer protection because you bought in lower. And what if you get spooked and sell early? You might actually realize interim losses because the buffer hasn't officially kicked in yet. Getting the timing wrong literally deletes the promised protection.
Finally, Section 6, the multi-period rollover trap.
We've talked a lot about the 2-year period, but what happens to investors who just set it and forget it after that first period ends? The mechanics of rolling over are so crucial to understand. When that initial 2-year period ends, the fund establishes a brand new cap and a new buffer based on exactly where the market is at that exact moment. Any market gains that occurred above your previous cap, gone, permanently forfeited. And if you had losses, actually scratch that. They aren't just losses anymore. They are now locked in as the new baseline for your new buffer. Plus, depending on market conditions, the new cap might be set significantly lower, which severely limits your future upside for the next 2 years.
The prospectus is shockingly direct about this long-term risk. It explicitly states, over multiple outcome periods, the fund may have losses that exceed those of the underlying ETF. It's a wildly counterintuitive reality. Holding this supposedly protective asset for too long over multiple periods can actually result in steeper losses than if you had simply held the regular, completely unprotected market index. And it's all because of how those caps and buffers constantly reset every 2 years.
So, the absolute crucial takeaway is this: even with perfect behavioral discipline, even if you buy exactly on day 1 and hold it without touching it for a full 2 years, there are still structural risks. The source clearly warns that there is no guarantee the fund will successfully provide the protection. You are entirely exposed to complex option valuation issues in illiquid markets and even counterparty risks, like the possibility, however unlikely, of the options clearing corporation actually becoming insolvent.
Which leaves us with a final, provocative thought. Is a strict 2-year lock-in actually worth the buffered peace of mind? When you look closely at the mechanics, it becomes crystal clear that zero loss isn't free. You really must carefully weigh that alluring marketing promise against the mathematical caps, the hidden structural risks, and the incredibly rigid behavioral discipline demanded by a 2-year holding period. The real question you have to ask yourself is, are you prepared to stay strapped into this roller coaster?